Hi there, we're getting you top reactions from big FIIs right here from Singapore. And I have with me a very special guest reacting to the budget, none other than Mr. Sukumar Rajah, who's the MD and CIO Asian Equities at Franklin Templeton. He oversees in his capacity as MD and CIO Asian Equities $7.5 billion worth of assets. Sukumar, it's great to have you on the show. Thanks very much for taking out the time to speak with us. Your initial assessment of the budget and what came out today?
I think overall it is positive. First of all, there are no negative surprises. The market was afraid about some capital gains tax or some other form of tax being imposed. So we didn't see any of those negatives. And they kept to the promise of the 3.5% deficit target.
Which was that a surprise?
No, I think it looked like they were going to keep to that. Because I think it's important to get rates down. And I think to get the rates down, I think the inflation has to be under control. And I think it's very good that they did that. So apart from that, there's a lot of trust on rural India, I think, which is very key as well. Because there has to be a feel-good factor. Without the feel-good factor, it's very difficult for the consumption demand to improve. And I think the politics also gets very messy when, a large portion of the population is not feeling good. So I think with increase in the expenditure in rural India, I think there's going to be a better feel-good factor. And also we can insulate by spending more on irrigation. I think there can be some insulation to the monsoon deficits which happen very frequently.
Sure.
There's more spending on infrastructure, which is very good. So overall, it's very good. So the only gray area is we don't know the fine print. So they have assumed certain, increase in revenues. We don't know where it is coming from.
Do you think that a revenue growth projection of 14% growth for FY17 is a bit ambitious, given how they undershot on tax revenues this year?
Right. So I think key is going to be what is the nominal GDP growth going to be. So
they are projecting 11%.
Right. But if you look at last year, the nominal GDP growth was very similar to the real GDP growth. So while the CPI inflation was 5%, and the GDP deflator was near zero. So we don't know what it is going to be there. If the GDP deflator is going to be lower, then I think it is possible, even after achieving about 7% real GDP growth, they could undershoot on nominal GDP growth. And if they undershoot on nominal GDP growth, then I think the revenue growth for the corporate sector would be lower. So indirect taxes and direct taxes might be affected.
So you question that, yes, they've kept to their commitment of 3.5%, but you question whether they will be able to achieve it.
All I'm saying is we don't know the fine print. So there is a risk that, if the external conditions are not good, that they can be short of some of the revenue targets. In which case, they cannot probably go full-fledged, they can't go full hog on the expenditure on many of the items that they hope to spend on. Sure. So that is a gray area. I'm not saying that they won't achieve that, but we have to see the fine print to understand what the risks are. Without looking at the fine print, it's very difficult to feel 100% confident about that part of it.
About execution. Okay, rate cuts, that's the next thing which is on everybody's mind. Given the fact that the equity markets are rejoicing, there's a bit of a relief rally in the equity markets, a bit of a relief rally in the bond markets, yields have come off. What are you expecting in terms of more rate cuts in addition to the 125 we've seen thus far?
So it's a function of how soon the inflation comes under control. I think Rajan has made it very clear that he's going to be data dependent. He wants to see the inflation come to much lower levels. If we see that happening, I think there can be substantial rate cuts. If we don't see that happening, then I think the rate cuts can be a little lower.
But what is your expectation on the rate cycle? When you're saying substantial rate cuts, more than 50?
Yes, I think more than 50 is a possibility if inflation comes under control very fast. And Rajan has confidence that the government is going to stick to the actual deficit will be close to what they are projecting.
How much do you think would suffice? I mean, if you're saying more than 50, are you saying 75 basis points or even 100 over the course of the next 12 months?
I think it's not ruled out. I wouldn't say it's the base case that we'll have a 100 basis point cut. But if the global situation continues to be deflationary, commodity prices continue to be pretty low, the government is sticking to the deficit targets. We don't see any big spike in food inflation. Then it's a possibility. So I would
But would
say
that do the trick, Sukumar? Do you think that, because a large part of the problem has been transmission, and given the state of the banks right now, credit growth being at 11% from 19% in FY12, do you think that can do the trick in terms of trickling down to the bottom and generating the kind of growth one wants to see, and also improving, investment, private investment, improving for that matter, utilization levels for manufacturing, for the manufacturing sector?
That alone is not going to do the trick.
Even 100 basis points, you think?
Not even 100 basis points. Because if you look at why companies are not investing, there are varieties of problem. There are some companies which are highly leveraged. So first they have to repay debt before they can start borrowing again. Then there are many industries where there's overcapacity. So there's no need to invest. And then there are a lot of infrastructure areas where I think it's not so rate sensitive, but regulation sensitive, politics sensitive. It's not just the central government politics. There's also state government politics.
Yeah, absolutely.
So I think this is going to give some tailwind, but this is, the rate cut itself is not going to be, something which will change the investment scenario overnight, within a 1 year time frame. But it will definitely help to some extent.
So you're saying 100 basis points rate cut also doesn't guarantee a pickup in growth numbers as much as one expects. There needs to be enough push from the government side in terms of fiscal measures coming in, more investment from
fiscal and regulatory and reform. I think all have to go hand in hand for, I think, sustained pickup in the growth numbers.
So you are also going to be waiting and watching out for how things shape up in terms of achieving that nominal growth of 11% over the course of the year?
So our investment strategy is not dependent on, they achieving 11% growth.
But it is dependent on earnings growth, right?
Not necessarily in the short term. So basically, if you're buying a company, next year's earnings is probably, if you're buying a growth company, then next year's earnings is less than 5% of the intrinsic value. So even if they miss that by 10%, it's going to make a difference of 0.5% on the intrinsic value as we calculate. So that's not the most important thing from my point of view. I think it's more from a market point of view or sentiment point of view. I think it's going to be more important. I think the 1 year performance of the market, to some extent, I think is going to depend on the visible pickup in earnings growth, and to some extent, growth is going to help. But more than growth, margins are going to be the key. For example, if there's going to be a 1% increase in revenue growth, it's going to lead to 1% higher earnings growth if margins are equal. But if 5% margin becomes 6% margin, there's going to be a 20% increase in growth.
Yes.
So the earnings is much more sensitive to margins. And margins are disappointed big time because of a variety of factors. One is the provisions that the banks have made. The globally sensitive industries have seen their growth being low, their capacity utilizations being pretty low, their pricing pressure.
Sure.
And then, of course, local demand also has not been strong, so there's been some capacity utilization problems, even in the local industries. So because of all these reasons, I think there's been tremendous margin pressure, and that's the biggest factor affecting the earnings trajectory. We need to see an improvement in margins for getting the biggest upgrade on earnings. I believe we are close to the bottom, but it's very difficult to say where exactly we are.
Perhaps the first quarter of FY17 you think can show signs of a pickup?
Any time now, I think we should start seeing a pickup.
But you think the worst is behind in terms of the earnings cycle?
From purely domestic factors point of view, I think so. But of course, the global issues are very difficult to predict. especially China. I think there's a lot of challenges that they are facing from a short-term point of view. So how all those things will play out in terms of global demand, global sentiment, is difficult to predict.
The bank recap plan, again, it undershot the broad expectations of the market. But, if you read between the lines, their commitment still holds. They want to fix the problem with the PSU banks. Does that reassure you as an investor? And would you look at buying PSU banks at these levels? Because at some point in time, if their commitment is there to clean up the mess, then there is value in these banks and they're ultra cheap.
We have been underweight PSU banks for many years.
Yes.
And even before the asset quality issues became very acute. There are two long-term challenges that they face. They are losing market share continuously because their service quality and what they deliver to the customers is inferior to what the private sector banks can offer. And then they have a top management problem. They cannot attract talent in the top management, and for that compensation and government policies are important. We are seeing some improvement, but we need to make much more improvement to gain the confidence that they can be as competitive as the private sector banks. So far, what has happened is a move in the right direction, but in terms of how far they're gone, I think not even 25% of the distance they need, of the total distance they need to travel to make them competitive.
And in terms of market sentiment, the fact that long-term capital gains tax was not talked about, is that a big relief? Yes, there's been some tweaking on the dividend distribution tax, dividend tax essentially, but not so much in terms of really rocking the boat in terms for market sentiment essentially.
Yes, I think that's a big relief. I think they manage expectations well.
That's true. That's true.
So put the fear in and ensure that those fears don't materialize.
Enough for you to actually increase allocations to India?
We are overweight in some of the regional products. So within the region, we are very confident about, or much more confident about the prospects of India. It's both on a bottom-up consideration as well as on a top-down consideration.
Yeah.
So we are overweight. For us to put more money in, we have to see flows coming into our funds.
Okay.
And for that, the global confidence has to improve.
China is moving towards a domestic-led economic model, and that just means that they're looking at, they're looking inwards for growth. And that's been advantage India for a long time. I mean, India is known for its domestic-led economic model. And with the thrust on rural demand, with investment in infrastructure, with pushing the rural economy forward, do you think that that's a theme that looks solid going forward? And which is why I said, do you think that China's loss of the step back in China, this transition in China is an important opportunity for allocation of money getting into India?
I don't see it that way. What I see India is where China was 20 years ago. Okay. It has the potential for all the four.
Close at an inflection point?
Where all the four engines can work. Demographics is in favor. Capital productivity can improve. Labor productivity is abysmally low. With urbanization and better mechanization and education, labor productivity can increase substantially. So basically, all the four engines can work in India's favor. And when four engines are working, it's easy to grow at a fairly rapid clip without overheating. So I think India to grow fast, I think there's an opportunity. I think I think we should forget about too much of direct comparison with China. China is in a different,
much larger economy. Yes,
it's much larger. It's in a different stage of economic development, and they are facing their problems because of number of reasons. Irrespective of what happens to China, even if China does well, I think India has a room to do, grow much faster. So that opportunity is there, and I think that's what I think investors need to focus on.
Okay, so given that the markets are so depressed right now, at 14 times 1 year forward earnings, perhaps people would say that there was some little more downside to the market from here, but largely coming into the buy zone historically, that the market calls for investors to put in capital at these levels. Where do you see the investment ideas, investment themes? Because from the start of the year, it's been a rough patch, which has thrown opportunities for investors such as yourself, who are long-term investors, to buy into sectors, where there could be growth certainty at reasonable valuations. And which are those names that you would be looking at, particularly if anything comes out or stands out as an opportunity from this budget?
Our top picks have not changed very materially over the last 1 year or even 2 years. So we like good quality banks because the savings will grow faster than the economic growth, because the savings rate will increase over a period of time. And financial savings is still a small portion of the total savings, and it will increase. And so we think good quality banks can grow at 18 to 20%, and also maintain very good levels of profitability. So we have a lot of ideas there. In consumer discretionary, we see a lot of opportunity. In quality industrials, again, with all the trust on infrastructure and building the India and creating manufacturing capacity, there are a lot of opportunities. So we see opportunities across multiple areas. We are by and large bottom-up stock pickers.
No new ideas have come to mind in this fall, the last 2 months?
I would say that our portfolios have not shifted dramatically. There's always going to be some change, and we cannot speak about what we are buying yesterday till our next fact sheet is out, etc. But I can say that there's been no dramatic change in the portfolio.
Would you look at infrastructure at this point in the turn in the cycle? Especially some of the power utilities, whether it's building roads, bridges, the NHAI projects that are being rolled out. Does that, especially companies with good execution capabilities as well as decent cash flows?
So we are not interested in utilities because we like to invest in companies which can generate good return on capital, and it's very difficult for utilities to generate very good return on capital. But we like to invest in companies which are providing the services, providing the equipment, etc. Because they're depending on the differentiation they have in their services and equipment. Sure. They can generate good levels of profitability and return on capital. So those are the type of companies we focus on from. These are the ways to play the infrastructure.
The export theme, IT, pharma, they hold ground?
IT sector, I think they'll continue to grow, but the growth will taper down. So as long as we budget for lower growth and put that in our valuation, I think it's still a very attractive sector. I think the businesses are sound. Same case with pharmaceuticals. I think the U.S. generics market, I think the growth opportunities will be lower. They have to move up the value chain to find growth. As long as those are built into our assumptions when we are valuing the stocks, then I think they're good.
Okay, Sukumar, as we wind down this interview, just getting the global angle into the picture as well, because the sell-off in India started with the globe. Jan was a tough month for global markets. How are you looking at the global picture? Two key triggers. One is the China slowdown, which is also, extending out to that argument is what's happening with the crude market, commodities largely being depressed and the crude market being depressed. And the second angle, which now everybody is going to be focusing on, is the Fed dot plot, right? What do they do with rates? Have they been too ambitious with anticipating the rate hikes for this year? How does all of that tie into India's position within emerging markets? Do you think that if there is pressure of outflows from across emerging markets, that no matter a decent budget, India will also come under pressure? Or do you think that on a relative basis, given the growth fundamentals, India can still hold on? The rupee has thus far, but it's cracked now. But do you think that can be a bit of a defensive trade in this volatile world?
India can survive a low growth global environment. Yes, our growth will be lower, but it's not a major issue. But of course, if there's going to be a major challenge one of the big economies faces, and there's going to be some sort of a crisis, which we still think is a low probability event, then obviously, India suffers as well. But so far, my expectation is that, all economies, including China, must be able to sort of avoid a crisis.
Because you have said that India is not just a brick in the wall.
Right. Yeah, I think it's a resilient economy, I would say that. But, no amount of resilience totally insulates India from, some big global event happening. But we think that chances of something like that happening is very, very low at this point.
Investors were expecting this budget to be one opportunity that the government would take to make bold measures and signal to the world that they mean business. Have they made the most of this opportunity?
Yes, I think they made a strong move in that direction to signal that they're very serious about business. Actually, the external perception is less of a challenge for the government than the internal perception. So I think outside, the intent of the government has been generally viewed positively, from what I gather from meeting a lot of people in various parts of the world. But I think, but when I go to India, I don't see the same amount of optimism. So there's more of an internal confidence issue than an
But markets are at pre-Modi levels.
Tough to say, because the markets, before the polls were suggesting that he'll come to power were at a substantially lower level. So it's very difficult to make that a statement that it's gone to that level of pessimism.
Well, from election day, that's the broad benchmark that we are following in India.
But also we have to note that the global environment has worsened. And even within India, the Indian corporates have not delivered. And the banking loan problem has been much bigger than what was expected earlier, which nothing to do with the government. So I think trying to just look at the level of the market and say that nothing has happened is becoming too pessimistic. I think there has been progress. And hopefully there'll be much more progress than what we have seen in the last one.
So your conviction holds?
Yes, absolutely.
All right, Sukumar. Thanks very much for taking out the time to speak with us. Really appreciate your views right here from Singapore.
Thank you.
Well, that's it. You heard it. Sukumar is still bullish on the Indian economy, and he believes that this has been a balanced budget. With that, we wrap up this edition of the FII View from Singapore. Thanks very much for watching the show.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.